Udit, Bharat, can you see the slide? What is written on the slide? On the top? Hedging,
Taking.
isn't it? Okay, so let's understand this is a very important concept, and there will be a question also in your exam on hedging. Okay, so please listen carefully. I'm recording also, so that you can watch later on if you have any query, and you can ask me any questions after the session is over. Okay, so basically, when what we do is that in future and options, particularly, we can use either futures or options to hedge our portfolio. Now, we might have invested a lot of money into stocks by buying those stocks in the capital market segment. That means we have bought shares which are sitting in our demat account. So we are a long-term investor, and we have bought we have made a portfolio. Okay, it can be for 10 lakhs, 20 lakhs, 50 lakhs, or whatever. Now you are holding a portfolio. Okay, now as long as the market goes up, you make money, isn't it? Now, suppose the market can come down also. And when the market comes down, like today, the market is down. I'll just show you the market today. They're down by quite a bit today. Okay. So let's see. Let's talk about, the Sensex. So can you see the Sensex today?
Yes, sir.
How much it is? How much it is down today?
900 points, sir.
That is quite a lot. About close to about 1.6%.
Yes, sir.
And the reason for it is basically is that, yesterday when the data came from US with regard to inflation there, the inflation in US has gone up to 7.5%, which is one of the highest in the recent history of US, because the inflation in US is, less than 1% or maybe 1.5%.
Right, sir.
So the inflation in US has come to about 7.5%. Okay. So, they've been talking about, raising interest rates. There is we have Reserve Bank of India, which came up the monetary policy yesterday for India, and the policy was quite dovish. Dovish means it was very accommodative, very good for the market, because the RBI said that we are not going to raise any repo rate or any interest rates in India because they are looking for growth. Okay, so whenever they feel that interest rates have to be increased, then they announce that and increase the repo rate and reverse repo rate and other things. So basically, which put brakes on the growth, because if the rate of interest goes up, then it becomes very costly for the business people to borrow money and do business. And for consumers, like for the housing loans or car loans, people don't take, because if the interest rate go up and the EMIs goes up. So yesterday when the RBI came, RBI announced its credit policy. It left the rates unchanged. That means they never announced that rates are going to go up. And they sounded very dovish also. Dovish means they were saying that there is little chance, or almost they gave us this thing, that they are not going to raise the interest rates in the near future. Whereas in America, it's just the opposite, where the inflation is going up. So they would like to check the inflation and bring down the inflation. So whenever the inflation goes up, they try to increase the interest rates so that the demand of money goes down and the interest rates hike can, check the inflation of the country. So if you look at, yesterday, I'll just share one more slide. 1 year, say, bonds in US, okay, or treasury, okay. So treasury, I think the treasury rate should be treasury rate in US today. So if you look at, a 1 year treasury rate, okay, or say, okay, if you, sorry, I'm getting some calls in between. So I'm just trying to show you a chart. So yesterday, what has happened is the interest rates in America have also gone up, and the treasury rates. I'm not getting it right now. The treasury rates have also gone up there. Okay, the rate of interest at which the government borrows is going up because of the inflation. So basically, what happens is that they would like to now go for an increase in America for the rate of interest, and they're fearing that interest rates they will hike at least one or two in a couple of months from now. So basically, the markets in
What
India
was the
has
interest rates in USA?
there it is. Short-term interest rates have gone up above 2%. They were hovering around 1.5% till few days back,
Okay.
and the interest rates for short-term borrowings yesterday has gone past 2%, which is a very high rate of interest. Okay, because there the interest rates have been around close to about 1.5% for a 1 year kind of a treasury rates. Okay, and even for 10-year treasury rates in America are close to about 2%, 2.5%. So yesterday there was quite a hike in interest rates in America in terms of the bond rates particularly. So government now would like to increase the rates in America. So which has and that is not good for the stock markets. Why? Because what happens is that when the interest rates are very low in America, a lot of money starts coming into the emerging markets from America, because it's an easy money in America, which people, the money they invest, they borrow and invest that money in the particularly countries like India, Indonesia, and other countries. Because if they are getting very low interest rates on their own bonds, say about 1% or thereabout, so it makes them, much better to put their money into other countries where they can make a higher return. When the bond rates in America go up, so then the money flows, back to America, because there, it becomes much, lucrative for them to make money without taking any risk. They can, earn about close to about 2% itself in the 1 year. The rate of interest is very low in America. So if they find that they're making 2.5%, so why they'll go and invest in, say, other countries. Okay. So that's why a lot of money starts, flowing out of India whenever the interest rates in America are going up. So the dollar flows back to their home country, that is America, if the interest rates goes up there. When the interest rates are very low in the US, then they find lucrative to put money in, say, countries like India, where they get a much higher return, but it comes with risk. Okay, because India is a risky place. Always the home country is much riskier, less riskier. So they would like to take the money back to US if they find the interest rates are much higher, without taking any interest, without taking any risk. They can earn much money in their own country, higher returns in their own country. So why they like to put money in countries like India or other emerging countries in the world? So that is today, that is a fear which the market is working today. And if you see the Sensex, it's down by about 1,000 points. It's a reaction to what has happened yesterday to the American markets. Okay, is it clear? Any questions there? Okay, so where we were, I'll just open my slides here. So so we're talking about hedging basically. Okay, so what I'm saying is that the markets can go down, like they have gone down today. And if you are having a large portfolio, like I have a portfolio close to about 5 CR. So if the market is down by say about 2% today, so I'll be losing a very big chunk of money if I think the markets are not going to recover very fast. Then whatever profits I've made, I'll be losing those profits for at least some time till the market revives. So then, what is the option left for a long-term investor? Can he go for hedging? So there is a way out where you can, avoid that loss which you're going to make if the markets come down drastically. Okay, fine. So hedging is basically which will protect you for any losses which may happen, because if the markets come down. Okay, so you want to protect yourself from such kind of a fall in the stock markets. So, but now before we understand what is hedging, we must know that stocks carry two types of risk. Whenever you put your money in a stock, or you buy a share like Reliance, Maruti, or whatever, you're taking risk, isn't it? Because stock market is risky, and when you invest money into these shares, there is a risk involved. Now, risk can be basically risk of upside as well as downside. You can make money if these stocks go up. If they go down, you lose money. Okay, but there is a risk when you invest into stock markets. Now, this risk is of two types. Okay, one is called the company specific risk, and other is called the market risk. Have you heard about these two types of risk? Anyone? Udit or
Yes. Yes,
anyone?
sir. Yes,
Eh,
sir.
Okay. So, company specific risk and market risk. So, company specific risk is basically associated with a company in which you are investing. And market risk is basically the risk which we are witnessing today is nothing but a market risk. Today, the market is down. It is not because the companies have performed poorly or a particular company. We are looking at the market as a whole. Okay, some bad news coming from America, which can spook our markets, and the stocks can go down. So that means the risk can be coming because of the company. The company is doing badly, and it's finding it's very difficult to make profits because of its own doing of their business, because of its own strategies not meeting. And they are failing to accomplish their own goals, and there can be a lockout or a strike or any kind of a bad event which can result in the share price to go down for a particular specific company. Okay, so company whenever we invest into stocks, there are two kinds of risk what we are taking: company risk and market risk. Now, can we hedge these risks? Can we eliminate these risks? Okay, can we do that? Can we eliminate the company specific risk or the market risk? Which risk can we eliminate? If I ask this question, which risk can you avoid if you are investing into stock market? Which is the risk where you can do something so that that risk doesn't hit you? Which is that risk? Udit, Ni- Nikita, are you there? Puru, Shrey.
Yes,
So
sir.
can you
Sir,
repeat it?
company, sir,
So
company risk.
I'm saying when
Sir,
you
company risk.
uh, uh, company risk you can avoid definitely. Puru, you are right. But how can you do that? If you have already invested your money into say 10, 20 stocks, okay, so how can you avoid? I mean, of course, you will say that you're not going to invest into that company, but you don't know. I mean, a good companies can come and hit you. Even a company like Maruti, suppose there's tomorrow a lockdown or a strike, and it is closed for a month or so, the share price will go down because the market don't like uncertainty. So the stock of Maruti may come down by 10 to
Sir,
15% in a matter of just
so
yeah.
I think only the way to avoid company specific risk is by investing in other companies of that sector only.
Okay. What else? What can you elaborate what you are saying?
Like, sir, if in a sector of telecommunication or in a sector of IT, there are companies like TCS, Infosys, Wipro.
Hmm.
We can invest in all of them, and if one company is
Okay.
underperformed, then it can be expected that other two companies can outperform.
Okay. Anyone else? I mean, of course, this is not a complete answer, but it needs a little bit refinement.
Yeah,
So I'll just
sir,
provide that.
investing in different industries like steel industry, automobile industry, and
Yeah, absolutely.
diversify
Yeah.
our
So
portfolio, sir.
Puru, sure, diversify your portfolio. That is what Puru is saying, and he's 100% right. By putting money in the same industry, actually you're increasing your risk. Something happens to a particular some bad news for IT or some bad news for pharma, the whole of the pharma stocks or IT stocks will fall down at the same time. Okay, fine. So if you invest your money into different industries, okay, suppose you have 100 bucks, and if you invest five rupees in various kinds of companies from different industries, so, it may happen that, one or two companies may not perform, but others may perform. Okay. So imagine in the worst case scenario, if you're holding, stocks in 20 companies. Okay. Suppose 10 companies, because of their own reason, they don't do well, but other 10 will do well. So the company specific risk can be avoided by investing in a portfolio of diversified companies. So you can always, avoid the company specific risk by making a portfolio a diversified portfolio. Is it okay? Bharat, have you got it?
Yes, sir.
So how you can avoid a company specific?
By diversifying and investing in different industries.
Yeah, absolutely, absolutely, absolutely. That's great. So, Puru, you are absolutely right in saying that. Now, the only risk which you can't, avoid is the market risk because that is not in your control. Okay. Now, something happening in America today, yesterday, and it has, the Sensex is down by almost like 1,000 points. You have no control and you can't do anything about it. Okay. But uh, we can hedge even the market risk. Since you have invested in a portfolio in a diversified companies, so you have already taken care of the company specific risk. But if the market falls today like 1,000 points, you will lose a lot of money and you don't want to lose. So in that case, what happens is the future on options gives you a tool whereby you can manage even the market risk. So let's understand. It's very interesting. Okay. Read this, Puru.
Yes. While company risk can be minimized by diversifying your portfolio, market risk cannot be diversified but has to be hedged.
So that means, as you said, that company risk can be minimized by diversifying. So it's coming as a slide. The market risk cannot be diversified, but it has to be hedged. So how will be hedging it? Read further.
So, how does one measure the market risk? Market risk can be known from beta.
So, what is market risk? If you want to know, what kind of market risk you're having in your portfolio or in a particular company. So you look at beta. Okay. Higher the beta, risky is that stock. Lower the beta, less risky is the stock. Are you aware of what is beta? Of course, I'll explain that in a little bit detail. But do you know who has not heard about beta so far? Just tell me.
I didn't heard it, sir.
Bharat, you have not heard about beta?
No, sir.
Okay, so many others would also be in the same category. But I think like Puru or people like Nikita or Udit, they might have, because I've been talking that also about this beta in my earlier semesters, as well as they might have read it elsewhere. So beta is basically, when you invest in a company or in a portfolio, so you are taking two types of risk. I told you the company specific risk and market risk. Now, company specific risk, you can always diversify and minimize that risk. But what happens to the market risk? That cannot be done. So, is there a statistical measure? Is there a formula or a statistical, metrics through which we can find out how risky is the company, how less risk? Now, all companies don't have the same amount of risk. First of all, we must know that companies differ on their risk, and even your portfolio, even if you have invested in a portfolio, it will carry some amount of market risk, and it will have its own beta. Okay, but beta tells you how risky is the stock. Now, the beta can be more than one or less than one. It's a statistical measure. Okay. I'm not going to tell you how we calculate beta. That for that I'll explain maybe end of the class. But think that beta is some number. Okay. If beta is more than one, the stock is riskier. If it is less than one of a particular stock, when I say Reliance has a beta of say 1.5, with this limited knowledge, tell me, and say Hindustan Lever has a beta zero point 0.5. Which stock is more riskier? Bharat,
So can you repeat the question?
I'm saying Reliance Industries has a beta of say 1.5, and other stock was say say Infosys or Hindustan Lever has a beta of zero point 0.5. Which stock is more riskier?
So the first one, 1.5.
That is more riskier. So anything above 1 is more riskier. Anything below 1 is less riskier. So which means the market itself has a risk of 1. So either a stock can be more than riskier than the market or less riskier than the market. When you say the market, actually we are referring to Sensex or a broader index or a Nifty. Okay. So any index which covers all kinds of industries, and which has a larger base. Like Nifty has 50 stocks and Sensex has 30 stocks. So ideally speaking, it will be the Nifty which we should use, or even the Sensex we can use, because it represents 30 stocks and it represents all industries in the country, whether it's a cement company, whether it's a steel company, or pharma company. All are basically the constituents of the index called Sensex or Nifty. But for better understanding, we should always take Nifty because it covers 50 stocks. It's a broad-based index, whereas Sensex is a 30 stocks index. Okay, so let's stick to for some time to Sensex at the moment. Of course, Nifty would be always a better example. So if you look at beta of say Sensex, so we say it's 1, and Nifty also the beta is 1. Okay, that's a market. So that means there will be some stocks which are riskier than the market, and there are some stocks which are less risky than the market. So if the market is 1, which is the baseline, okay, so some stock will be more riskier than the market and some stocks will be less riskier than the market. So as a thumb rule, if I say, this question comes to you, Bharat, just listen to me and answer this question. And then if you don't answer, then Udit or Puru or anybody, Shrey or Lakshya, anybody can answer, okay, or Nikita or anyone. So if suppose the Sensex goes up by 10% on a particular day, if the Sensex goes up by 10%, that means it rises by 10%. And a particular stock, okay, for example, say Reliance, goes up by 15% on that particular day. Okay, or other way around, if the Sensex falls down by 10% and Sensex also, the Reliance also falls down by 15%, then what is the beta of the Reliance? So in that case, we take the Reliance stock increase divided by the market, how much it has gone up, and calculate the beta. So rise in the Reliance stock divided by the rise in the Sensex, and vice versa. The fall in the Reliance divided by fall in the market. So if that is a formula, tell me what is the beta of Reliance? Bharat? No idea?
So 1.5.
Okay. 1.5, absolutely. Because Reliance is, witnessing a much exaggerated, movement compared to the market. So if the market goes up by just 10%, Reliance goes up by 15%, and other way around also. So Reliance beta will be 1.5%. That's great. Okay. Now if I say, if the market goes up by 10% and Hindustan Lever goes up by only 5%, and both other way around also, then what will be the beta of Hindustan Lever? Bharat? Should I repeat my
Yes,
question
sir.
again? If Hindustan Lever goes up by 5% and the market goes up by 10%,
0.5,
other
sir.
way around also. 0.5. Okay. So that means which stock is more riskier, Hindustan Lever or Reliance, if we look at this kind of information? Of course, Reliance is riskier because it is having
More
a
higher.
higher volatility. So it is higher, it is more volatile than the market. In other way, Reliance is more volatile than the market, and Hindustan Lever is less volatile than the market. Okay. Now, the companies which are doing a business of, like consumer staples, which are selling FMCG products, okay, they will always have beta less than 1. Because these companies, the type of business is such that these stocks will, always keep growing their bottom line and they will have a steady income. Whereas companies like, for example, Maruti, people, they will always carry more beta because their bottom line or their profitability will keep fluctuating with the, every rise and fall of the markets, or because of the, the economy. Because if the economy is doing very well, Maruti stock will also do very well. Okay, because it has more beta compared to the market. It's more riskier. So if the market goes up, the economy does well, then it is always better to put your money in Maruti because it will, keep rising more than the market because it has a beta more than one. Okay, but Hindustan Liver, it's a steady stock because it is not going to be impacted by the market, what is happening in the economy, because people keep buying their products because their products are, consumed by general masses. Whereas Maruti product is such that it is called a discretionary product where people use their discretion. If the economy is not doing well, people are not making money, so they're not going to buy cars. So their profitability will dip. So when the economy does well, the Sensex also rises. There are certain stocks which rises more than Sensex. There are certain stocks which rise less than the Sensex. Okay, it all depends upon what kind of business the company is doing. So beta is dependent upon basically the type of business. Okay, so the businesses which are very volatile because of the market situation or the economic situation, they will always carry a higher beta. Now, if I tell you one more question, example, Sun Pharma. Have you heard about this company, Bharat?
Yes, sir.
Now, can you tell me, will it beta be more than one or less than one by looking at the company itself?
Sir, I don't know.
Puru or anyone? Nikita?
Sir, more
Udit?
than one.
No, like Sun Pharma. What they are manufacturing?
Some medicines.
So medicines, even if the economy is going down, or situation is very bad, like we had a pandemic. So people will, their profitability, the market will come down, but the Sun Pharma will do well, isn't it? Fine. So Sun Pharma is not going to get impacted because of the market. So they always have a lower beta. Okay, companies like pharmaceuticals, companies like which are making goods which are used by general masses, and they are not so much volatile compared to the market because they keep doing well most of the time, unless of course there can be some specific reason to Sun Pharma because of their some problem with US because they're supplying a lot of medicines to US and other countries. So because of that, it may have a little higher beta, but otherwise businesses which are more stable, okay, which are not linked to the economic situation of the world or country, they will always command a lower beta. Now you can always look for the beta. Okay, let's say if we can find the beta of some companies. Okay, so open and just try to find out beta of, say, for example, beta of Hindustan Liver. Just press. Are you seeing this on your screen?
Yes, sir.
Hindustan Liver. So what is the beta of Hindustan Liver? Let me just pull out this Hindustan Liver. So what is the beta of Hindustan Liver, which is given here?
0.03.
So it is very, very low. Okay. So let's say, say Reliance Industries. So what is the beta of Reliance Industries?
1.01.
So is that Reliance riskier or which was the earlier company, Hindustan Liver? Which was more riskier?
Reliance.
Okay, let's look at DLF. DLF would have a higher beta or lower beta? A higher beta because they are manufacturing, so beta is coming 0.7, by the way. I know why it is coming, this thing, okay? So let's say, for example, Maruti. So what is the risk beta of Maruti? 0.9.
0.9.
Okay, so each company has a beta. So if it is more than one, then it is riskier than the market. If it is, less than, greater than one, it is, uh, more riskier than the market. Okay, so let's, just stay with that at the moment. Okay, so is the beta clear to you? Somewhat,
Yes,
Bharat
sir.
and others? Okay. So beta is something which measures the risk, okay, of a company, particular company. Okay. Fine. Now you may have, many stocks. Okay. So you take the beta of all the companies and calculate the beta of the portfolio. Okay. Fine. You can do that. Okay. Suppose if I say, for example, you have two stocks, okay, in your portfolio. Each stock 50% in value. So that means you have invested 50 rupees in, say, a company like Reliance, which has a beta 1, and say another 50 rupees you have invested, say, in Hindustan Liver. The beta is 0.5. So what will be the portfolio beta for you? Udit? Puru? Have you got my answer? Should I repeat my question?
Yes, sir.
So,
Okay. So what I'll do, I'll just put this thing in an Excel sheet so that you can get here. So are you seeing the Excel sheet
Yes, sir.
on your screen? Suppose you have invested in two stocks, Reliance, okay, say 50 rupees, okay, and the beta is say 1.5. So let this be beta, okay, and this is your investment value, how much money you have spent, okay, fine. And the other stock is say Maruti or say Liver, Hindustan Liver, HLL, Hindustan Liver. So I'm referring to HLL, Hindustan Liver. So you have put say 25 rupees or say 50 rupees, okay, here, and the beta is 0.75. So what should be your total investment is how much? 100 rupees. Okay. So your total investment is 100 bucks. So what we do is basically we multiply this with this. Okay. And then multiply this with this. Okay. Fine. Uh, then we actually divided this by 100 also, is it? 1.5. Okay. So I'm just totaling up okay, first. And then I'm just making this 100 here and then calculating the beta of the portfolio. Or I can do one more thing, okay, I'll just avoid doing this 100. So if your investment is 50% here and 50% here, so what is the combined beta now of the portfolio?
1.125.
So this is the beta, okay. Now if suppose you make your beta, now the portfolio beta is 1.125. Is your portfolio riskier compared to the market?
Yes, sir.
Compared to what is the beta of the market? Beta of the market is 1, isn't it? Suppose if you make it 60% here, okay, and make it 40% here, what happens to your beta? It goes down. Suppose you make it, 70% here and say 30% here. So what is the beta now?
0.9, sir.
So I call this as beta, okay. Fine. So beta is, so it is very easy to calculate the beta. So you just, calculate the percentage of your investment, multiply it with the beta, okay, and your beta, combined beta, this will be your portfolio beta. So portfolio beta is very simple to calculate. Okay, you can always calculate by taking all your investment and working out the percentage of the money you have invested in each stock and putting the betas in front and then calculating the simple weighted average beta of a portfolio. Is it clear how we calculate the beta of the company of the portfolio?
Yes, sir.
Okay, so what I can do, I can just add some more. Okay, like Maruti. Fine. And make it, this as 20%. Fine. And make this as 50%. And let's say beta of Maruti is say uh, zero point 0.9, what we saw. Okay. So now the beta of your investment is how much?
10, sir.
0.1x.
No, this one,
Yeah.
1.005, isn't it?
Yes. Yes.
This is your beta. So this is how you calculate the beta of the portfolio. Okay. So now let's come back to this thing. So we know that beta. So just read now, Puru.
Yes, sir. The beta measures the relationship between movement of index to the movement of the stock.
So that we have seen that, it is basically nothing but the movement of the stock versus the movement of the index. That is a market like Sensex.
The beta measures the percentage impact on the stock price is a 1% change in the index. Therefore, for a portfolio whose values goes down by 12% when the index goes down by 10%, the beta would be 1.2.
So if suppose, you have a portfolio whose, beta is 1.2. So that means if the stock market goes up by 10%, then the portfolio will go up by 12%. Have you followed that? Suppose you have a portfolio which has a beta of say 1.2. That means your portfolio is riskier. Okay. So it can go either way. If the market goes up by 10%, that means your portfolio will go up by 12%. Okay. Read this.
When the index increases by 10%, the value of the portfolio increases 12%.
So is this clear? If you have a portfolio whose beta is say 1.2, so it will always give you a higher return when the market goes up, and it will give you a lower return compared to the market when the market falls. Have you followed? Should I repeat?
Yes, sir.
Yes means what? Have you followed or should I repeat?
Yeah, please repeat, sir.
I am saying that you have a portfolio, okay, whose beta is say 1.2. Now tell me, is this portfolio risky compared to the market or less risky or more risky?
More riskier, sir.
More riskier. So if the portfolio is more riskier, if the market goes up by 10%, what return you will get on your portfolio? What is the expected return you will get? 12%. Okay, if the beta is 1.2. Now, if the market goes down by 10%, how much loss you can suffer in terms of percentage? 12%, because it is more riskier. Now, have you got it?
Yes, sir.
Okay. So let's go here.
Sir,
Okay, just read it. Yeah.
what happens if the beta value is 1, exactly 1? Will it be considered as
Then
riskier
you
or
no, it will be, it will not be considered riskier. Okay. It will have the same risk as with the risk the market has. Of course, it will be riskier, but it will have the risk because, all portfolios are riskier, whether it is, less than one or more than one. It is only we are looking at how risky it is compared to the market. Okay. If the portfolio is one, that means there is a risk, but the risk is the same as the market risk. Have you got it? भाई आप तो पैसा स्टॉक मार्केट में लगा रहे हो ना. It is riskier. You can't say that it has no risk, but the risk will depend upon how much risk you have. If your beta is say 1.2, then you are saying that the portfolio is riskier than the market. Okay. If the portfolio is 1, then you say that portfolio is same risky as the market. But if the portfolio is having a beta of say 0.5, then you say that the portfolio is less riskier than the market. Okay. We are not saying that you are saying that there is no risk. Have you got it now?
yes, sir.
Okay. So now read it, Puru.
The idea is to make beta of your portfolio zero to eliminate your losses.
So basically now the question arises that you want to basically avoid the market risk. Now when you avoid the market risk and you have already avoided the company specific risk, so that means you will not going to make any profit or loss for that period till the time you have made your portfolio beta as zero. If you have a beta zero, then we say that you don't have a risk at all. Okay. So if you make the beta of your portfolio to zero, then you will not suffer any loss. Okay. Now, under what conditions you would like to make your portfolio beta zero? Only if you think the market is going to fall. Okay. For at least 15 days, 20 days, the market is not going to go up and I don't want to suffer any loss on my portfolio. In that condition only, you will like to make your portfolio beta as equal to zero. Okay. Now let's understand how you will do it. Read further.
Hedging involves protecting an existing asset position from future negative price movements.
So basically, you're trying to hedge your portfolio. That means if anything happens to the market, you don't suffer any loss.
In order to hedge a position, an investor needs to take an equal and opposite position in the futures market to the one held in the cash market.
So basically, when you have a portfolio, that means you are long in the cash market because you are already invested your money in the market by buying, all those stocks, and you have made a portfolio. So you have a long position in the cash market, or we say the capital segment market. But now you have to take an opposite position in the futures market. That means you are going to short the market, the future and options market, to hedge yourself. So let's understand how it does happen. Okay, read this.
Assuming you have a portfolio of rupees 1 million, which has a beta of 1.3, you can factor a complete hedge by selling rupees 1.2 million of S&P CNX X Nifty future.
So that means, in short, it says that if you have a portfolio of 1 million or 10 lakh rupees, which has a beta 1.3, how you can hedge yourself? By selling or taking a short position in Nifty futures. Okay. So what are the steps? First step.
Determine the beta of the portfolio.
So first step is that you find out the beta of the portfolio.
Short sell the index in such a quantum that the gain on a unit decreases in the index would offset the losses on the rest of his portfolio.
Okay, so let's understand this, how it is done. So therefore, in the above scenario, we have to short sell 1.3 million worth of Nifty because our portfolio's beta is 1.3. So 1.3 into 1 million. So that means I have to go short on Nifty to the extent of 1.3 million worth of Nifty. Okay. Now let us study the impact on the overall gain loss that accrues. So let's first take one example. Suppose if the index goes up by 10%, okay, what happens to the portfolio? It will go up by 1,30,000 because you have invested 10 lakh rupees. So 10% increase would actually generate a profit of 1,30,000 on your portfolio. Okay. But in the futures market, you are going to lose because you have taken a short position in the Nifty. So you thought that Nifty will go down, but actually Nifty has gone up by, the portfolio has gone up by 10%. So which will make you in a loss position in Nifty, okay, by the same amount. So the effect will be nil, okay. But if you take the other way around, if the index goes down by 10%, you will make a gain in your short position because the index has come down, the Nifty has shown a fall, okay. So you are going to make a positive profit on Nifty, but you are going to lose money in the cash market. So again, in both the scenarios, neither you have made money nor lost money, and you have protected yourself from the second situation where the index is down by 10%. So this is what you were fearing. Okay? You were thinking that the index will go down by 10%. In that scenario, you lost 1,30,000 in your portfolio, but that loss was recovered in the futures market because you made a gain of 1,30,000. So net effect was neither there was a loss nor was a gain. Okay. So let me just explain this through an further example. Okay. Look at this example. So you'll understand it very easily. Read this example. Bharat.
Example, X holds HDFC Bank worth rupees 7,41,150 rupees lakhs at rupees 152 1,525 per share on January 1st, 2022.
Now you have some stocks of HDFC Bank. Okay, so they are worth rupees 7,41,150. Okay, so you have this portfolio, nothing else. Okay, your portfolio consists of only HDFC Bank, and the value of HDFC Bank is 1,525 rupees per share. Now tell me how many shares will be holding? You divide 7,41,150 by 1,525. So these many shares you have. Tell me how many shares? Anyone?
Sir, 486.
So let me just calculate for you. 741 150. Okay. Divided by 1525. So 486. That means you have 486 shares with you of HDFC Bank. Okay. And this was a situation on 1st of January to 22. Okay. Assuming that the beta of HDFC Bank is 1.19. Okay. So is HDFC Bank riskier than the market? Say yes or no.
Yes, sir.
Okay. How much Nifty futures does X have to sell? Now, if he thinks that the market is going to go down, okay, fine. Suppose this guy X thinks that the market is going to down. Okay, so which I have not written here. I'll add that box. He thinks that Nifty is going to go down. So that case, he has to, take a short position in Nifty. So how many Nifty is going to sell? The index future is ruling at 17,650. Okay, fine. Which is expiring. This is basically a January contract. I mean, which is expiring on 27th of January, which has already gone. So if the index is trading at 17,650, how many index future he is going to short? So this is one question. On January 20th, 22, so that means after 20 days, Nifty future is trading at 17,100. So is the Nifty gone up or gone down after 20 days? So Nifty was trading at 17,650
Gone up, sir.
on first. It has fallen. So the market has come down. Okay. So HDFC Bank share is quoting at 1,474 on 20th of January. So is HDFC share come down or gone up compared to the 1st of January?
Down, sir.
It is down. So that means if you are holding HDFC Bank, you will be losing. So how much you will be losing? So how many stocks were you having? 741, 150 divided by 1525. Sorry, how much money you have lost? Can you calculate? So 486. Okay. So let me just calculate here for you. Suppose you would have been having, you not hedge yourself at all. So, your HDFC Bank has come down to 1474 from 15, how much? 1525 minus 1474. 1474. So, how much money you have lost? 51 rupees per share. And you are having 486 shares with you. So how much the money you have lost, Puru?
24,786.
So that means if you are holding, HDFC Bank on 1st of January, which was valuing at, 7,41,150, 7,41,150. So the share price of, HDFC comes down to basically 1474. So that means you're sitting on a loss of 24,786. Or other way around, we can say that 486 into 1474. So what will be the value of your stocks on that day? So that means you're having your portfolio has come now to 7,16,364. So it was worth 7,41,150 on 1st of January. And today it is worth how much, Udit?
7,16,364.
So are you sitting on a loss or sitting on a profit?
So loss,
Lots
sir.
of
So you want to avoid that loss. Okay, that is your aim. You want to avoid this kind of a loss. You don't want to incur this loss. So what you will do? You will hedge your portfolio, or you hedge your this investment. So what you will be doing basically? So calculate the gain or loss if X squares his position on 20th of January. Okay, so let's talk about it. To hedge, he needs to sell 7,41,150 lakh into 1.9. So that means he has to sell index futures worth 8,81,970 lakhs. Okay. Portfolio कितने का है 7,41,000. If you multiply it with the beta, so what we'll do, we'll take 8,81,970. We'll divide by the index value, which is prevailing at the time of 1st of January, which comes to 49.97. So one lot of Nifty is 50. So he has to, he has to take a short position in Nifty futures, one lot. So what he has to do, he takes a short position in Nifty, okay, one lot, okay. So now let's understand. On 20th of January, Nifty is trading at 17,100, SDFC is trading at 1474, okay. So what he does, he has taken a short position. Now he takes a long position on Nifty to square off his position. Okay. So what happens? Gain on Nifty future. How much? It was at the beginning 17,650. Now it is trading at 17,100 into 50 because he has taken a short position on Nifty for 50 stocks. So how much money is going to make in Nifty? 27,500. Now tell me, is it clear to all of you? What he has done, he has sold someone Nifty at 17,650, okay, in the month of January. So he has a right to sell to someone Nifty at 17,650 per share, okay. Now he finds on 20th of January, Nifty is trading at 17,100. What he's going to do? He's sitting on a profit, so he's going to take an opposite position. First he, took a short position. Now he's going to take a long position in the market and going to book his profits. How much profit is going to make? The difference of the two. So the profit is 27,500. Have you understood how he has made the profit, first of all?
yes, sir.
Who said yes? Bharat?
Yes, sir.
So Bharat, which position he has taken at the beginning of the contract? What position he has taken? Long or
Short,
short?
sir.
And in the short, you make money when the price goes down,
Yes,
isn't
sir.
it? So in this case, Nifty has come down to
Okay.
17,100. So he is going to offset his position. He is going to
Long
take a
position.
long position in Nifty now. So to basically book his profit. And each Nifty is for 50, each lot. So he's going to make 27,500. Now what happens in the HDFC? In HDFC, he makes how much? Loss of profit. So HDFC has come down from 1525 to 1474. And how many shares he have got? 486. So is he making loss or gain in HDFC Bank?
Loss, sir.
Loss. So now what is his net gain or loss? Is he making a net gain or net loss?
Net gain, sir.
So now, if he had not taken a hedge, how much money he would have lost? Had he not taken a hedge, Had he not taken a short position in Nifty at the time of 1st January, how much loss he would have made? Udit, Puru,
So 2714.
27? No, no. Had he not taken any short position in Nifty, अगर उसने hedge ही ना करा होता, had he not taken a
Sir,
hedge, he would have left his
24,786.
absolutely. He would have been sitting on a loss of 24,786. By hedging himself, by taking a short position in Nifty. Now, whatever position you have in your portfolio, the position is that you are long on HDFC Bank because you have bought it. You are a long-term investor. You are already long in the cash market, so you have to take a short position in Nifty. So you took a short position in Nifty, fearing that the Nifty will come down, okay, and you will make money. But your portfolio will go down, but Nifty will give you a gain. So net, you're still making money, you're not losing at all. Is that clear? This is called hedging. Should I just explain it once more a little bit? Have you followed, or should I just run through once more?
So followed, sir.
Followed. Everyone, Lakshay, Udit, Siva, Ketha, have you followed?
Sir,
Okay, if you have followed,
so why do we multiply 1.19 with the with amount 7,41,000?
okay, have you joined late today?
Yes, sir, I was having some network issues today.
Okay. Now, I explained that. I'll share the recordings also with you shortly because I'll just share it on a hard drive on your disk. This thing. So you'll be able to listen to that part of the recording and understand why we do that. Now, just to give you a little bit more, the same question which you asked, because if your portfolio is riskier than the market, okay, like we just go back to this example. So tell me, what is the beta of HDFC, Nikita?
So 1.19.
So when the beta of HDFC Bank is 1.19, we say that it is riskier than
Yes, sir.
Nifty. Because if the beta of any stock is more than 1, then we say it is riskier than the market. Okay. So since it is beta is 1.19, so it may fall more than the market. Okay. Or it may rise more than the market. In case if the market goes up, it will rise more than the market. But if it falls, it will fall. If the market falls, it will fall more than the market. So in that case, what we do is we have to take a short position more than the value of HDFC stock. Okay. So what we do is we just multiply it by 1.19. By taking a short position only of 7,41,000 will not help. Because if the HDFC stock falls, then it will fall more than the market. How much more? 1.19 times more. 0.919 more, okay? So it is almost equivalent 20% more risky or 19% more riskier than the market. So that means we have to take a short position 20% more than the value of or 19% more value of HDFC stock itself. So that's the reason we have taken a short position worth 8,81,970, which is factoring that HDFC stock is more riskier than the market. How much? 19% more, which means that we have to take a short position of Nifty futures more than the value of the HDFC bank stock itself. Then only it will provide us a perfect hedge. Otherwise, we'll not be getting a hedge. Okay? Have you got it, Nikita? Now,
Yes, sir.
fully or little bit?
Sir, so when we got 8,81,000, we divided it by 17,650. That was the Nifty uh, at that
That
time.
time on 1st of
Yes,
January.
sir.
Yeah.
So we get 49.97. What we would do with this 49.9?
Because 49.97 is the number of Nifties which you should go and short. But you can't short less than 50 because one lot of Nifty is 50. Okay. So you can't go to the market and say, I want to short 49.97. So you are going to take a short position in Nifty futures for one lot. Okay. Like, each stock has its lot size. Like we have seen, Reliance has a short, lot size of 250. So you can't take a short or long position in just 1 or 10 stocks on Reliance. You have to do in terms of its lot size. So Nifty has a lot size of 50. Okay. So what you do is now you take a short position in Nifty, one lot. Okay. Fine. And one lot is equal to 17,650. So which will provide you a complete hedge against any risk which you are going to experience by fall in HDFC Bank stock. So if the HDFC falls, you're going to make money in your short position. You're going to lose your money in the long position, which is your HDFC Bank itself, but that will get offset against the gains which you're going to make when the Nifty falls. Okay, like if you look at here, what happens? The Nifty has fallen. Nifty has fallen. You have already taken a short position, so you'll be going to make a profit in Nifty. Okay, but in your portfolio, you're going to lose money because HDFC Bank has fallen down from 1500 to how much? Look at, what was the price of, HDFC? 1474. Okay, so it has come down to how much? 14, sorry, it was 1500.
1525.
It 1525. So 1525, it has come down to 1474. So you are making a loss on HDFC Bank, but at the same time, you're sitting on a profit on your Nifty short position. Okay. So because on 20th of January, you thought now the worst is over and HDFC Bank is not going to fall further or it is going to remain same, but you have already lost money. So you wanted to, book your profits on Nifty so that whatever money you have lost on HDFC Bank, you're going to recover that. Okay. So you're, hedging your loss of HDFC Bank against a short position of Nifty. Okay. So what you do here is, first of all, we'll calculate the gain on Nifty futures. How? Because now you are going to square up your position. On 20th of January, what you'll do, you will take a long position in Nifty, which will close your Nifty position. Okay. So once you have done that, you will be sitting on a profit. You sold Nifty at 17,650 and you bought Nifty at 17,100. With the result, on one lot, you made, that is lot of 50 Nifty, you made a profit of 27,500. Is it clear?
Yes, sir. Clear.
So you are making a gain on Nifty future because you have short the Nifty earlier. And since if there is a fall in Nifty, you're going to make money. Had Nifty gone up, you would have lost money in your this position. Okay, but here you have gained. But even if the Nifty would have gone up, you would have been making a loss in Nifty, but a corresponding gain in HDFC Bank. So now, if you are making gain in Nifty, you are making a loss in HDFC Bank. If suppose the situation would have been Nifty would have gone up, so you would have been making a loss on Nifty future, but gain in HDFC Bank. So which you would have neutralized your gain and loss. So in this case, you are sitting on a gain of 27,500 in Nifty future, but you are making a loss in HDFC Bank, which is actually providing you a complete hedge. Okay, for at least for 20 days, you know that you have not lost anything. So if you just calculate your net gain and net loss, you're still sitting on a gain of 2,714 because you have perfectly hedged yourself. So you'll never make any loss, never make any gain of a big amount, okay, till the time you have played this strategy. So this is a strategy whereby you are protecting yourself that your portfolio doesn't go down. If it goes down, then you are going to recover that loss by taking a opposite position in the Nifty futures. You are long on your portfolio, you take a short position in Nifty. So net, you are hedging yourself. Have you got it now? Any questions, please? So there will be a question in your exam to answer it. It's a very simple one. Have you got it now, Bharat?
Yes,
Is
sir.
it clear? How much? 100% or less than that? Ketharaj,
Yes, sir.
पुरु, केता समझ में
Yes,
आ
sir.
गया आपको अच्छी तरह से? Okay, so I am still finding little bit. Okay, we'll do something more later on so that it will become 100% clear. Okay, next time. Now the time is limited. So next time, I'm going to take an example of only Nifty as I took in the case of Reliance or other stocks earlier. So we'll understand only Nifty. Okay, how does it make? Puru, have you got it?
Yes, sir. Yes, sir.
And Udit, how about you?
Yes, sir. Got it.
And Nikita, ये समझ आ गया? अब कोई
Yes,
क्वेश्चन
sir,
है आपके
clear.
पास?
Clear. 100%.
100%? Okay. So fine. So now we are moving for the attendance now. Okay. I'm just stopping the recording here.